You do everything right. You pay your bills. You keep your credit cards under control. You wait years before applying for a mortgage because you are trying to be responsible, which in America usually means delaying happiness until a spreadsheet gives you permission. Then the lender pulls your credit report, and suddenly you are not the responsible person anymore. You are risky, not because you missed a payment, not because you borrowed too much, because somewhere inside the American credit reporting machine, an account that is not yours, a late payment that never happened, or a collection that should not exist got attached to your name. And here is the part that should make your stomach drop. That one mistake can quietly change the price of your life before you even know it exists. A stranger can make one typo in a database, a debt collector can report the wrong account, a credit bureau can match the wrong file, and you can pay for it for the next 30 years. That one mistake can cost you more than $50,000 in extra mortgage interest, not because you bought more house, not because you borrowed more money, because the system decided you were riskier than you actually were. Here's the thing. There is a private financial reputation file following you around America, and most people only discover what is inside it when somebody else uses it against them. A lender, a landlord, an insurer, sometimes even an employer. And if the file is wrong, the damage can happen before you ever get a chance to explain yourself. Before you ever sit across from the loan officer, your file has already walked into the room and introduced you. And if that file lies, the lie gets heard first. That is the trap. Not that credit reports exist, not that lenders want to estimate risk. The trap is that Equifax, Experian, TransUnion, and the companies feeding them data can help create a version of you that is financially worse than the real you. And once that version exists, you have to fight to prove you are not the person the database says you are. The villain is the credit reporting system built around Equifax, Experian, TransUnion, and the data furnishers that feed them: banks, debt collectors, credit card companies, auto lenders, utilities, medical collectors, loan servicers, and anyone else with the power to put a mark next to your name. And if that mark is wrong, the system does not pause. The mortgage quote does not pause. The apartment application does not pause. The insurance premium does not pause. The job background check does not pause. The only thing that pauses is your life. And this is not rare. The CFPB received about 2.7 million credit or consumer reporting complaints in 2024. The most common issue is incorrect information on a report. So when people say, just check your credit, they are skipping the real question. Why is a system this powerful allowed to be this wrong? Credit reporting feels official. It has the emotional texture of a government record. It sounds neutral, mathematical, and clean. A credit report, a credit score, a risk model, a file. But behind that file is a giant private data market where companies send information about you to other companies, those companies package it, sell it, and when the information is wrong, you become the unpaid quality control department. Look, if a restaurant brings you the wrong order, you can send it back. If Amazon ships you a lamp instead of a toaster, you can usually show the box and get it fixed. But if a debt collector reports an account that is not yours, or a bank reports a late payment that was never late, or a credit bureau mixes your file with someone who has a similar name, you may not find out until someone with power over your life says, "Sorry, your file came back with a problem." And by problem, they mean more expensive. Sometimes dramatically more expensive. So let's open the machine. Because this is where most people misunderstand the trap. They think a credit report is a careful record. It is not. It is a data supply chain. And supply chains are great at moving information quickly. They are much worse at stopping and asking, wait, is this information actually true? A company has information about you. Maybe it is your credit card issuer. Maybe it is your auto lender. Maybe it is a mortgage servicer. Maybe it is a collection agency that bought a debt from another collection agency that bought it from another company, which is already a sentence that should make everyone quietly stare at the wall. That company is called a furnisher because apparently calling it the company that can ruin your week with a spreadsheet was too honest. The furnisher sends data to the credit bureaus. Equifax, Experian, and TransUnion collect that information and attach it to your credit file. Lenders, landlords, insurers, employers, and other companies buy access to those reports or use scores created from the information in those reports. Then decisions get made. Approved, denied, higher rate, higher deposit, different terms. No explanation beyond the report. Here is the part most people miss. Your credit report can speak before you do. Before you explain anything, the file has already made the first impression. Before you sit with the loan officer. Before you explain the medical bill. Before you say, that collection is not mine. The file has already walked into the room and introduced you as someone less trustworthy. And the system does not automatically say, wait, before we make a life-changing financial decision, maybe we should verify that this negative mark is actually real. No, it says, the report says what it says. And here's where it gets interesting. The credit bureaus do not make most of their money from you checking whether their product is accurate. They make money because other businesses need their data. You are not really the customer. You are the subject. The file is about you, but it is not primarily made for you. That is the whole design tension. The lender wants speed. The landlord wants speed. The credit bureau wants scale. The furnisher wants its data accepted. The debt collector wants leverage. And you want accuracy. Guess which incentive is weakest? Exactly. When a credit bureau receives information from a furnisher, it does not proactively call you and say, "Hey, this collector says you owe $1,840. Does that sound familiar?" It does not require courtroom-level proof before that information can affect your score. The system is built on mass reporting, millions of accounts, millions of updates, automated flows, matching algorithms, name, address, social security number, date of birth, account number, balance, status, payment history. And when that machinery works, it feels invisible. When it fails, it becomes your emergency. Ask yourself this: if a false late payment appeared on your report tonight, would you know who put it there? Not which bureau shows it. Who actually caused it? The bank? The collector? A billing company? A debt buyer? A software feed? Because that confusion is not a side effect. It is part of why the system is so hard to fight. Here's what most people don't realize. A credit report error is not always dramatic. It does not have to be identity theft with someone opening a Ferrari loan in your name. Sometimes it is a payment marked 30 days late when it was paid on time. Sometimes it is an account that belongs to your father because you have the same name. Sometimes it is a collection account that was already paid. Sometimes it is a debt that was discharged in bankruptcy but keeps reappearing like a financial ghost with no respect for boundaries. Sometimes it is a medical bill that should not have been sent to collections because insurance was still processing it. Sometimes it is an old address, a mixed file, a duplicate account, a balance that should be zero, or a debt that is too old to be reported. And sometimes it is a software problem. That sounds abstract until you remember that the CFPB ordered Equifax to pay a $15 million penalty over improper investigations of credit reporting errors. The Bureau said Equifax ignored consumer documents, allowed previously deleted inaccuracies to come back, and relied on flawed software that contributed to inaccurate credit scores. That is not one person forgetting to upload a receipt. That is infrastructure. An infrastructure failure does not look like a villain twirling a mustache. It looks like a letter that says, "We verified this information as accurate," even when you know it is wrong. Now you might be thinking, okay, but there is a dispute process. And yes, technically there is. That is what makes this so frustrating. The system gives you a remedy, but only after the harm has already started. First, you find the error, which already assumes you checked your report before something important happened. Then you dispute the error with the credit bureau. You explain what is wrong. You attach evidence, you circle the item, you upload documents, you write a letter, you keep records. You send it by certified mail if you are being careful, because apparently fixing someone else's data mistake now requires the energy of preparing a small civil trial. Then the credit bureau generally has to investigate. But the bureau usually does not personally know whether your payment was late, whether the debt is yours, or whether the collector's account history is correct. So the bureau forwards the dispute to the furnisher. The furnisher is often the same company that provided the wrong information in the first place. So the company that made the claim gets asked whether the claim it made is correct. That is not an investigation. That is the financial equivalent of letting the student grade their own exam, then telling the teacher, "Good news, he passed." And sometimes the answer comes back, "verified." That word sounds official, but in many cases verified does not mean a neutral person proved the debt was yours. It means the original source repeated the original claim. That is the machine. Dispute, verified. Dispute again, verified again. Upload proof, still verified. Call customer service. No one can see the document. Mail documents. They were not received. Send certified mail. They were received but not reviewed. Get a result letter. The result letter does not explain the result. Ask for details. Receive another template. At this point, the consumer has done more investigative work than the company selling the report. Here is the nightmare question. What if the truth is on your side, but time is not? Because credit report errors do not usually show up when you have nothing going on. They show up when a deadline is already chasing you. A mortgage closing, a car loan, a rental deadline, a job screening, a refinance window, a divorce, a move, a medical emergency, a family situation where waiting 30 to 45 days is not a small delay. It is the difference between getting the thing and losing the thing. And remember, the FTC has said information in your credit report can affect your ability to get credit, insurance, a job, or a place to live. That means the consequences are not theoretical. This is not just a number. It is access. Access to borrowing, access to housing, access to employment, access to affordable insurance, access to normal adult life without being treated like a suspicious file. The cruelest part is timing. A wrong mark in a random month is a problem. A wrong mark during a mortgage application is a financial ambush. And the system has a very convenient emotional trick built into it. It makes the victim feel guilty. Because the error is attached to your name, it feels like your shame. You see delinquent, you see collection, you see charge-off, you see past due. Even if it is wrong, the words are designed to sound like a verdict. And most people do not immediately think, a private database may have failed me. They think, what did I miss? That hesitation helps the system. It makes people slower to fight. It makes them accept worse terms. It makes them overpay to make the problem disappear. It makes them call a collector and pay a debt they do not owe because the mortgage is closing in 3 weeks and they cannot afford to be right slowly. Here's what most people don't realize. Credit reporting is not just a memory system, it is an enforcement system. If a debt collector can place a collection account on your report, that mark can become leverage. Maybe the collector cannot easily sue you. Maybe the amount is disputed. Maybe the paperwork is weak. Maybe the debt is old. But if the account appears on your credit report right before you need financing, the collector suddenly has power, not because the debt is valid, because the timing hurts. That is the quiet genius of the machine. It does not need to knock on your door. It waits until you need approval from someone else. Then the file speaks for you. And sometimes the file lies. Consumer Reports and Work Money found that 44% of people who successfully checked their credit reports found at least one error. More than a quarter found potentially serious mistakes. So when someone says, this probably happens to other people, the uncomfortable answer is, yes, and you may be one of them. You just may not know yet. Even if you want to be conservative with that number, the FTC's older national study found that 1 in 5 consumers had an error on at least one of their 3 credit reports, and about 5% had errors that could lead to less favorable loan terms. 5% may sound small until you apply it to a country where credit reports touch almost every major financial decision. 5% is not a rounding error. 5% is millions of people. Millions of people who may be paying more because a file is wrong. And for the people inside that 5%, the problem is not statistical. It is personal. It is the loan officer saying, your score came back lower. It is the landlord saying, we went with another applicant. It is the insurer saying, this is the premium. It is the employer saying, there was an issue in the background check. It is the awkward silence where you are suddenly expected to explain a debt you have never seen. So let's do the math, because this is the part where a small database error turns into a very real wealth transfer. Say you are applying for a $300,000 mortgage. At a 6.5% interest rate, your principal and interest payment is about $1,896 a month. Now imagine an incorrect collection account or false late payment knocks your credit score down enough that your rate becomes 7.25% instead. At 7.25%, the payment is about $2,047 a month. That is roughly $150 more every month. Not for 1 month, not for a year, for 360 months. Over the life of the loan, that difference is about $54,000. That is the number. More than $50,000. Not because you bought more house, not because you borrowed more money, not because you missed a payment, because the system priced you as riskier than you actually were. That is what makes this so grotesque. The error is small enough to look like paperwork, but large enough to move tens of thousands of dollars from your future into somebody else's revenue stream. And here is the ugly part. The credit bureau does not pay your higher mortgage payment while the dispute is pending. The furnisher does not pay it. The lender does not pause the rate. The seller does not hold the house. The landlord does not hold the apartment. The employer does not hold the offer forever. The error creates the urgency. Then the urgency weakens your ability to fight the error. That is not a bug. That is the economic shape of the system. The most expensive part of a credit report error may not be the error itself. It may be the timing. A wrong mark in a random month is annoying. A wrong mark during a mortgage application is a financial ambush. Now zoom out. Credit reporting is supposed to solve a real problem. A lender does not personally know whether you pay bills on time. A landlord does not personally know whether you have a history of unpaid rent. An insurer wants to price risk. An employer in some roles may look at background information. So America built a massive private identity and risk infrastructure. The bureaus collect the data. The scoring companies model the data. The furnishers supply the data. The users of reports make decisions from the data. Everyone points to the next person, when something goes wrong. The lender says, we relied on the report. The bureau says, we got the information from the furnisher. The furnisher says, our records show it is accurate. The collector says, we bought the account. The original creditor says, we sold the account. And the consumer says, I have no idea who half of these companies are, which honestly is a pretty reasonable response. Because the modern credit reporting system is not built like one relationship. It is built like a supply chain. And supply chains are very good at moving things quickly. They are much worse at explaining who is responsible when the wrong thing arrives. Here is the counterintuitive part. The company that denies you may not be the company that harmed you. The harm can move through a chain where every link says the problem is somewhere else. Now, the industry will tell you the system has safeguards, and technically, it does. Credit bureaus are supposed to use reasonable procedures to assure maximum possible accuracy. Furnishers have duties when they report information. Consumers have dispute rights. Bureaus generally must investigate within 30 days, and sometimes they can take up to 45. If information cannot be verified, it should be corrected or removed. On paper, that sounds like a functioning system. But a functioning system is not measured by how nice the statute sounds. It is measured by what happens when an ordinary person uses it while under pressure. And under pressure, every small friction matters. The report is hard to read. The account name is unfamiliar. The collector name is not the original creditor. The same account appears differently across the three bureaus. The online dispute portal pushes you into short categories. The customer service person cannot explain the investigation. The furnisher says to contact the bureau. The bureau says to contact the furnisher. The lender says it cannot change anything until the report updates, and by the time the report updates, the rate lock may be gone. That is the part nobody puts in the brochure. Accuracy eventually is not the same as accuracy when it matters. If your mortgage rate is based on wrong data today, a correction 3 months later does not automatically refund the house you lost. If your rental application was denied today, a corrected report later does not magically put you back at the front of the line. If your car loan was priced higher today, the system does not automatically send you a nice apology card with a check and a little note saying, "Our bad, we accidentally made your life worse." The machine moves forward. You are the one who has to chase it. And that is the central violation. The system can be wrong on Monday, cost you money on Tuesday, admit the correction later, and still never truly put you back where you were. A correction is not the same thing as repair. Now let's talk about who gets hit hardest. People with time, money, stable housing, good records, and legal confidence can fight longer. They can send certified mail. They can print statements. They can call during business hours. They can wait out a delayed loan. They can hire a lawyer. They can pay a higher deposit and keep moving. But if you are already living close to the edge, a credit report error is not an inconvenience. It is a trap door. A false collection can mean a rental denial. A rental denial can mean another application fee. Another application fee can mean less cash for the deposit. Less cash for the deposit can mean staying in a more expensive situation. A higher auto loan rate can mean a bigger monthly payment. A bigger monthly payment can mean less room for emergencies. Less room for emergencies can mean one real missed payment later. And suddenly, a false negative mark helps create a real financial problem. That is how systems compound harm. They do not just punish existing risk, they manufacture it. And the most brutal part is that the official record can feel more believable than the person standing in front of it. A tenant says, "That debt is not mine." The report says it is. A borrower says, "That payment was on time." The report says it was late. A job applicant says, "That account was fraud." The report says collection. And institutions trust the report because the report feels objective. Data has a halo. Numbers feel cleaner than people. A score feels less biased than a conversation. A report feels less messy than an explanation. But bad data does not become fair just because it is printed neatly. Bad data at scale is still bad data. It just has better formatting. That is why this episode is not really about credit scores. It is about who gets believed first in America. The person or the file about the person. Here is the psychology section because this is where the machine gets really ugly. People blame themselves because credit scores are marketed like personal responsibility meters. The higher the number, the more responsible you are supposed to feel. The lower the number, the more ashamed you are supposed to feel. So when the file is wrong, the first emotional reaction is not outrage, it is embarrassment. And embarrassment is useful to the system. Embarrassed people do not escalate as quickly. They do not tell friends. They do not ask, who profits from this? They ask, how do I make this go away? That is the psychological trap. The credit reporting industry turns a data quality failure into a personal character problem. And once that happens, the burden quietly shifts. The company does not have to prove to your lender that it is right before the damage happens. You have to prove to the system that it is wrong after the damage starts. And this is by design. Not necessarily because every individual employee wakes up thinking, "Today I will ruin someone's mortgage." Most systems are not that cinematic. It is by design because the incentives are designed that way. Fast reporting is valuable. Cheap processing is valuable. Automation is valuable. Standardized dispute handling is valuable. Selling reports is valuable. Detailed human investigation is expensive. Slowing down negative reporting until every fact is verified is expensive. Giving consumers clear explanations is expensive. Building systems that prevent deleted errors from reappearing is expensive. And when the people paying the biggest cost are not the direct customers, accuracy becomes a compliance obligation instead of the center of the business. That sentence matters. A compliance obligation is something a company manages. A business model is something a company optimizes. Credit bureaus optimize data scale. Consumers need data accuracy. Those are not the same thing. This is the part that sounds boring until it ruins your life. Accuracy is expensive. And in this system, the person who needs accuracy the most is not the person the industry is trying hardest to please. Now, the industry has an argument, and the argument is not completely fake. Not every dispute is valid. Some people dispute accurate negative information because they want it removed. Some credit repair companies flood the system with questionable disputes. Some complaints are incomplete. Some consumers misunderstand what can legally stay on a report. That is real. But that argument does not solve the core problem, because accurate credit reporting is too important to be handled like a customer service ticket. A credit report is not a newsletter subscription. It is not a restaurant reservation. It is not a rewards app. It is a private file that can change the price of housing, transportation, insurance, and borrowing. When that file is wrong, the correction system should be incredibly clear, fast, and accountable. Instead, millions of people describe a loop. And the loop sounds like this. I disputed it. They verified it. I sent proof. They said it was verified. I called the furnisher. They sent me back to the bureau. I called the bureau. They sent me back to the furnisher. I filed a complaint. They updated one bureau but not the others. The account disappeared. Then it came back. That last part is especially maddening. Because a consumer thinks removal means victory. But inaccurate information can sometimes reappear if the underlying data pipeline is not fixed. So the consumer wins the battle and still loses the system. A deleted error that comes back is not just a paperwork failure. It is the system telling you, even when you win, you may have to keep winning. And now for the deeper reveal. There is not just one file with your name on it. There are dozens. Equifax, Experian, and TransUnion are the three most people know. But the consumer reporting ecosystem includes specialty reporting agencies that maintain separate files on you. Check systems can track banking history, like bounced checks or account closures, and banks may use it when deciding whether to let you open an account. LexisNexis Risk Solutions maintains reports that can include insurance claims history. Tenant screening companies can maintain rental history files. Employment background screening companies can prepare reports for employers. Every one of these systems can contain errors, and many people do not discover those errors until they are denied something. A bank account, an apartment, an insurance quote, a job. So when someone says, "Check your credit report," that is useful, but it is incomplete, because the file that hurts you might not be the one you thought to check. Here's the thing. America has built a private reporting universe around ordinary people, and the ordinary person is usually the last one to see what is being reported. That is the real power imbalance. You are visible to the system long before the system is visible to you. So what can you actually do? Not in the motivational sense. Not in the take control of your financial destiny sense, because this is terms apply, not a seminar in a hotel ballroom with bad coffee. Think of this less like advice and more like survival instructions for a system that already assumes you are the inspector. First, pull your reports from annualcreditreport.com, especially before applying for a mortgage, car loan, apartment, insurance, or any job where a background check may matter. Do not rely only on the score inside your banking app. The score is the smoke alarm. The report is where the fire is. Look for accounts you do not recognize, late payments that were not late, duplicate collections, wrong balances, wrong personal information, old debts that should not still be reporting, accounts marked open that should be closed, anything that looks like identity theft. Second, if you find an error, dispute it in writing with the bureau that shows the error and with the furnisher that supplied it. Be specific. Do not write, "This is wrong." Write, "This account is not mine," or "This payment was made on this date," or "This balance should be zero," or "This account was included in bankruptcy," or "This collection is a duplicate." Attach copies, not originals. Keep everything. Dates, screenshots, letters, tracking numbers, names, confirmation numbers. Paper helps you. Vibes do not. Third, if the error is serious, do not rely only on the online portal. The portal can be useful for simple mistakes, but for serious errors, create a paper trail. Send the dispute by certified mail. Send it to the bureau. Send it to the furnisher. Keep copies of every document. If you were denied credit, housing, insurance, or employment because of a report, read the adverse action notice. Under federal law, it should tell you which reporting company was used and how to request a copy of the report. That notice is not junk mail. That notice is a map. Fourth, if the error is not fixed, escalate. File a complaint with the CFPB. Contact your state attorney general if appropriate. And if the error is serious, repeated, and costing you money, talk to a consumer attorney who handles Fair Credit Reporting Act cases. That is not because lawsuits are fun. They are not. Lawsuits are paperwork with trauma lighting. But sometimes the system only starts listening when the consumer stops sounding like a customer and starts sounding like liability. And notice what these steps have in common. They are all unpaid labor. You become the investigator, archivist, paralegal, follow-up department, and emotional damage control team. And that brings us to the verdict. The villain is Equifax, Experian, TransUnion, and the data furnisher system that lets banks, collectors, lenders, utilities, medical collectors, loan servicers, and other companies feed life-changing information into private credit files before ordinary people ever know there is a problem. The number is $50,000 plus. That is what a 100-point credit score drop can cost on a mortgage when it pushes you into a higher rate. And the broader number is even louder. Millions of credit and consumer reporting complaints year after year with incorrect information sitting at the center of the mess. This is not just bad paperwork. This is a privatized financial reputation system where the file can be wrong, the damage can be immediate, and the burden of correction lands on the person least equipped to stop the machine quickly. So yes, check your reports. Yes, dispute errors in writing. Yes, keep records. Yes, escalate when the template letters start looping. But do not confuse those steps with justice. Those steps are survival instructions for a system that should have been built with more accountability in the first place. Because if a company can sell a report about you, that report should be accurate before it costs you money. Not eventually. Not after 3 disputes. Not after a CFPB complaint. Not after you lose the apartment, miss the rate lock, or pay thousands more for a loan. Before. That is the standard. And the fact that this sounds demanding tells you how low the current standard has become. Because the real scandal is not that mistakes happen. Mistakes happen in every system. The scandal is that this system can make the mistake profitable for everyone except the person being mistaken for someone else. So here is the question I cannot get past. If a company can damage your mortgage, your apartment application, your insurance premium, or your job offer before proving the data is right, is that really credit reporting? Or is it punishment by spreadsheet? Has this happened to you? A wrong account? A false late payment? A collection that was not yours? A score drop you only discovered when you applied for something important? Drop it in the comments. I want to know how it played out. Because the credit reporting system is built on files, but the damage shows up in people's lives. And as always, they did not break the law. They wrote the workflow. Terms apply.